So, as we said in the introduction, federal budget in Canada, and I do want to say before we get into it, yes, this is very Canadian content, but I think it's interesting for anybody to listen to because there's a lot of interesting decision-making concepts in here, and we've done some cool modeling, and cool modeling is always fun for anybody anywhere. I talked to somebody about this morning on the day that we're recording this, who is not in Canada, and we were talking about other stuff, and he asked about the budget, and I started talking about it. And then I realized, like, you're not from Canada. Like, you don't care about this. And he's like, no, this is super interesting. Please keep going. So anyway, all that to say, if you're not Canadian and this does not affect you directly, you may still find the discussion interesting. So,
well, and in the U.S., there was a recent proposal to change capital gains on, I think they're income testing it or at least scaling it in based on income levels. So while obviously that's not a complete analog to what's going on in Canada, you know, our American listeners are dealing with decisions around capital gains as well. So to your point, Ben, I think some of your thought processes that you're going to discuss might be relevant in some cases, at least how to approach the decisions.
Yeah, very good point. I'm always just wary of our global audience when we're talking about such a Canada-specific topic, but I think it's going to be interesting for anybody. Okay, anyway, so Canada's federal budget recently proposed an increase in the capital gains tax rate, and we'll talk about the way that they did that, the mechanism they used in a second. But what that means is that when you're selling a taxable asset like a business or a secondary real estate property, in Canada we have a primary real estate tax exemption. So if you sell your primary residence, you don't pay tax, but a secondary property you would pay tax, or a taxable investment portfolio. You sell that for more than you put into it. That's a capital gain. You pay tax on that. They're proposing to increase the rate on that. One interesting piece about this is that in the proposed change, it would not take effect until June 25th. So any gain realized before June 25th will be taxed at the old lower rates. And so that is what opens the door to all of the analysis that we've been doing. Like, people have between now and then, potentially, because this still hasn't passed in a law, but assuming it does, between now and June 3rd, I guess, if you take settlement into account, to do stuff. But that, like you said, Cameron, people could make a lot of mistakes too, because if people run out and sell their assets now because they're worried about this, one, it's not passing a law, so it could just go away, which that would be a whoops. But also, even if it does pass in a law, there are a lot of cases that we'll talk about where it actually would not make sense to sell an asset now and pay tax at the lower rates. Anyway, so we'll get more into that in a sec.
Well, not all assets can even be sold on that short of a timeline, right? Like, depending on, I mean, even like secondary properties, rental properties, vacation properties, like that just all depends on what the market's doing.
Anything can sell for the right price. So if people are really worried, they might, you know what I mean? Sell their cottage for way under market.
You see some headlines of people rushing out to sell their cottage properties. I'm like, you're likely going to take a bigger haircut on the price, perhaps, if you have to make a market.
I saw that headline, but the sources were all realtors. I'm always skeptical about
exactly.
Yeah. But like a business, for example, or even some investments just aren't liquid. They have liquidity windows, like only quarterly redemptions or annual redemptions. So it's like the portfolios we're talking about are generally, like you said, 2-day settlement, right? We click a couple buttons and it's sold. But there are others who have illiquid property that they don't have the luxury of being able to click a couple times and make that decision.
Yeah. Can you talk a little bit more about what a capital gain is, Mark, just before we keep going, so people are on the same page?
Yeah. Yeah, and you mentioned the rates are going up, and so it's like the tax rates are not necessarily changing. What's changing is the amount of the capital gain that gets included in your income. So traditionally, when you have a capital gain, so you buy something for X and you sell it for more than X, the difference in value between your cost and the market value or the sale value of that asset, traditionally only half of that gain would be included in your income for tax purposes. The other half you stick in your jeans tax-free, right? So if you have a $100,000 gross capital gain, half of it, $50,000, goes on your income tax return as income and is taxed at, essentially your marginal rates or effective rates. The other half is tax-free. Yeah. The proposed changes, with certain limitations, would increase the inclusion rate. So instead of including half of the capital gain in your income, you would include 2/3 of it in your income. It's still going to be taxed as income at your marginal rate, but the amount of the capital gain that you include is potentially going to go up. Now, you're going to talk about this, I know, but for individuals, they've put a $250,000 annual threshold. So under $250,000 of annual capital gains, you can still avail yourself of the 50% inclusion rate, basically the old rules. It's only on the dollars above that $250,000 threshold where they're talking about increasing the inclusion. However, for corporations and trusts that retain capital gains income, there is no threshold. So if you have a small business corporation, I was on Twitter talking to professionals and doctors last week, but for them, there's no $250,000 threshold. So the proposed changes are such that inside a corporation, if you have a corporate investment portfolio of whatever stocks, bonds, ETFs, every dollar of capital gains inside the corporation would be subject to this new higher inclusion rate. So that's how it works, and that's the proposed changes.
Yeah, that personal versus corporate thing / trust thing is super important because it's you know what? I'm not even going to continue making comments on that. Maybe we can come back to that later.
Okay.
That's the part that gets very contentious. Who should get the $250,000 of?
No.
Anyway, we'll leave that alone for now. Okay, so a little bit of history, and yes, this is Canadian, but trust me, it'll still be interesting. So capital gains in Canada were not taxed at all prior to 1972. I found some really interesting historical research on this, detailing historical Canadian tax rates. Since 1972, the top combined federal and provincial capital gains tax rate for individuals in Ontario, and that's just the data I was able to find, and this is accounting for the inclusion rate that Mark was talking about. So this is the top tax rate multiplied by the capital gains inclusion rate in that year. So it's been as high as 39%. That was in the 1990s, and as low as 23% in the 2000s. So that means you're paying 39% of your capital gain in the 90s, 23% in the 2000s. This budget proposal, by increasing the inclusion rate, like Mark was talking about, from 50% to 2/3 to 67%, it would increase the overall top tax rate in Ontario on a capital gain to a little more than 35%. So pretty close to the highest it's ever been at the highest rate in Ontario. Most of that variation historically is due to changes in the inclusion rate, not due to changes in tax rates. So similar to what we're seeing now, tax rates aren't changing, but the inclusion rate is changing. So that it causes historically there's quite a bit of volatility in the capital gains tax rate, and it's largely due to the inclusion rate. So that's kind of interesting. The current inclusion rate, like we've mentioned, has been 50% since 2000. It was 75% from 1990 through 1999, 66%, close to what it's going to be proposed to be now, in 1988 and 89, and then it was 50% before that since 1972 when it was initially put into place. So yeah, that's kind of where we're at now. The corporation piece, as we've mentioned, is really important. So if I look at, instead of the highest personal rate being 35% in Ontario, I won't explain the full mechanism, and it's pretty complex and it depends on a lot of different assumptions. But if we just assume somebody owns a corporation, they have an asset inside of their corporation that they sell for a gain, a capital gain, and they immediately distribute the proceeds, the after-tax corporate proceeds, to a shareholder. So we've got two layers of tax here. We've got corporate tax, we've got personal tax. We're assuming that they're paying that personal tax immediately, which would not always be the case, because in a corporation, you could realize the gain inside the corporation and not flow it out personally to pay the personal tax. Anyway, it's probably getting too deep in the weeds there on corporate tax, but the top rate under this change would be 38.6% for somebody, call it whatever, 39% almost, for realizing a gain in a corporation and flowing it through to a shareholder. Previously, it was about 29%. So corporations, they don't get that $250,000 exemption for the old inclusion rate, and the overall rate that they're paying is a decent chunk more than an individual earning a capital gain.
And that's in Ontario, right? Like different provinces, the math will be slightly different.
Correct. Yeah, those are all Ontario numbers for both the corporation and the individual. A lot of individuals will probably be protected by the $250,000 limit.
Yeah.
How many? What proportion of people? That's another very contentious point, because in the budget documents they claimed it's a tiny fraction of people that will be affected by this change because of that exemption. To the extent that that's true, that's great. But my judgment is that a lot more people than were indicated by the stat in in the budget document will be affected by this. Because like anyone that has, and I know we have biased samples because we talk to people who have money generally because that's who's interested in what we have to say and that's who our clients are. But a lot of people have secondary properties or taxable investment portfolios with gains above $250,000. So I mean, it'll touch a lot of people.
Well, and I think
I'm
on
not
that
saying
point,
that's a bad thing.
yeah, and agree without getting political about whether this is good or bad. I think my concern was that the way that the budget was presented, what they did in order to determine how many people were going to be impacted by this or how many corporations were going to be impacted by this, they looked at a single year and they said how many corporations had a realized capital gain in this single year. And the number I think was 307,000. So it was a very, very small number. When there's over I think there's around 1.2 small businesses registered in the country. So it wasn't a huge number. The problem with doing it that way, in my opinion, is 2022 was not a great year for assets. Right. So you had stocks were down, real estate was down, bonds were down. So people may have, like behaviorally, many people may have just not triggered gains or losses in their corporation because it was not necessarily a good year to do that. Maybe many had losses instead of gains. But also, to your point, Ben, that doesn't capture the unrealized capital gain that everybody else has on all of these assets. So a single year's data, to me, isn't a good way to look at this because anybody who has an unrealized capital gain in a corporation is affected. Anybody with perhaps a secondary property, a vacation property, a cottage, a cabin is going to be affected. And every estate, when somebody passes away in Canada, there's a deemed disposition on all of those assets. And so many estates are going to be captured by this as well. And none of that was clear from the way that the budget was presented.
Yeah, that's a big one. That when you die, the second on the death of a second spouse, typically because you can do a tax-free rollover on the death of the first spouse most of the time. Death of the second spouse, all of your taxable assets are there's usually a deemed disposition.
That's right.
On death. So even if someone's deferred gains for their whole life, then in the year of death, they'll tend to have a large capital gain. And again, maybe that's great. Maybe that's a good thing because it'll raise tax revenue and it'll on wealth transfer. And maybe I'm not saying that's a bad thing. That's just what it is. That's what'll happen.
Yeah, we're not tax policy wonks here.
Yeah, and I don't want people to get upset with us for our opinions on tax. I'm trying not to have opinions, just saying what's happening. One interesting point that I found going through the budget supplement was that employee stock options are also affected by these proposed changes. So if you have qualified employee stock options in Canada, they previously received a stock option deduction for half of the stock option benefit. And that's proposed to be decreased to 1/3 for amounts over $250,000. So it's very similar to capital gains. One interesting point on that is that the $250,000 limit to get taxed at the old rates is shared by stock option income and capital gains income. I just thought that was an interesting point. So,
well, I think that's quite important, right? Like because depending on the sector you work in, like a lot of technology companies, part of the compensation they offer their clients or their employees is stock options, right?
Yeah.
And so they don't have the benefit of having separate, like now their compensation is potentially wrapped up in the capital gains changes. And I'm not sure that was the intention, or at least when people are thinking about the $250,000 threshold, they're thinking about assets that have appreciated in value from just sitting on them. But now we're getting into potentially compensation being affected too. Yep,
I agree. We work with a lot of people in technology who have stock option income, and yeah, for sure, this will affect them on both levels.